I was wrong about mortgage interest rates. In this video, I'm going to talk about three things. The fact that I was wrong, where I think mortgage rates are headed in the future, and what would happen to the real estate industry if mortgage interest rates actually did go sub 5%. Stay tuned. All right, Matt, the Mortgage Guy, residential mortgage broker, licensed across the country. If you want to connect me and my team, greatmortgagebroker.com. In today's video, I've got to just come clean and first and foremost say, I was wrong. We started to see inflation come down. We started to get report after report that inflation was on the downtick. And I said, here we go, guys. Mortgage rates, not in a straight line, but slowly but surely over time are headed down. And so let's take a look at how wrong I was. All right, here's the 30-year fixed rate mortgage news daily. If you watch the channel, you know that I use this quite a bit because it's a good national average. And if I can find this spot right here, February 2nd, it wasn't that long ago where that 30-year fixed average across the country was 5.99%. And one short month later, on March 2nd, exactly a month later, 7.1%. Had a good day on Friday the 3rd, so it came down to 6.97. But needless to say, my predictions around mortgage rates continuing to go down were off base. They were wrong. And I'll tell you the economic data that came out that made it so. Mortgage rates fluctuate on a daily basis, and they change every single day, sometimes multiple times per day. And it's based on other factors. Sure, what the Fed's doing and them manipulating the Fed funds rate, moving that up and down, things going on socioeconomically across the world can impact mortgage interest rates. But the one that I've been watching a lot, and I think is probably the number one indicator to watch when you're watching mortgage interest rates, is inflation and jobs. And what the Fed has said in so many words is they want to cool down inflation without crashing the economy. They want to, quote unquote, smooth landing. And so the jobs report that came out, 517,000 jobs. That's a whole nother video and a whole nother topic on how those numbers were probably not very accurate, but those are the numbers that the Fed is using. Gave the Fed permission to say, look, the economy's strong, jobs are good. We can be even more aggressive when it comes to raising interest rates to curb inflation. And so that was a big driver of a pretty nasty February that caused mortgage interest rates to continue to get worse. Looking ahead, March 10th, March 14th, we've got economic data in the future that I think, my buddy Barry Habib thinks, others think is going to be favorable to mortgage bonds and pull mortgage bonds back down, mortgage interest rates coming down. So stay tuned for all that stuff. I didn't want to get too technical around that. I just wanted to, one, say that I'm wrong. Two, tell you where I think mortgage interest rates are going, because I still think mortgage interest rates over the next 6 to 12 months are going to come down. You saw in the graph that I threw up, they're at roughly 7% right now in March of 2023. How soon and how fast can interest rates come down? We saw a 1% increase in a month, which is pretty dramatic, right? And I don't expect mortgage interest rates to go down in the same dramatic fashion, but over the next, call it 3 to 6 months, with enough economic news that shows inflation headed down, we certainly could see mid fives, low fives on the 30-year fixed by the end of 2023. I won't get as aggressive as others and have a timeline that's closer than that, but over the next 9 months, seeing mortgage rates come down from 7 to 5.25, not out of the realm of possibility. So with all that being said, it it's a good, in my opinion, kind of thing to consider is what would sub 5% mortgage rates do to the housing market? Tons of doom and gloom about the current housing market and affordability and 28-year low for demand and all the negativity, right? We're in a really weird market in most parts of the country where even though affordability sucks, even though demand is at a 28-year low, there's nothing for sale and housing supply is, dismal in a lot of areas. Prices aren't necessarily coming down as much as people would like them to. From the peak of, call it Q2 22 to Q1 of 23, some markets are seeing it 8% cheaper than the peak, some 12% cheaper than the peak. But still, for some people, it's not enough because what they could buy at one price with a 4% interest rate, they can't buy and have the same payment even if they get a 10% discount today because of the mortgage interest rates attached and the cost of the capital to borrow it. So, we don't have toxic mortgages. We don't have anything, that's going to cause the housing market to go into tailspin like we did back then. But I won't even get into that. I'm just going to talk briefly, right? Like if mortgage interest rates went sub 5%, it would cause demand to come back in the housing market. In my opinion, it's not going to cause chaos and, so much demand that there's 20 offers on every house. I think it's going to bring normalcy back because it'll bring back buyers, but at the same time, it's going to bring back sellers as well. And I'll tell you why. Somebody who's got a 3.25 right now is very hesitant, and I know this because I talk to these people, to trade in that 3.25 mortgage for a 6.25 or a 6.5 or a 6.75, right? Because that delta is too big. The cost to move up or move sideways, or in some cases move down, is too much. You bring rates down to 4.75. Now, all of a sudden, existing homeowners, won't be dealing with this mortgage lock-in. They can stomach a move from 3.5 to 4.75, from 3.75 to 5.25. They can stomach that. It's just this 3.5% jump that they really, are just saying no thanks to. So it's going to cause more demand. We all know that, right? But if it causes more demand and at the same time brings a bunch of inventory back, it's just going to look like a more healthy housing market with more people buying and more people selling and more movement in the market that more resembles what most would consider a normal market. First-time home buyers, that number one issue is affordability. It'll ease up for them, right? The cheaper interest rates associated to these bring that payment down, and all of a sudden we'd solve for affordability in a lot of cases. So ideal scenario really for the housing market is that we've seen a 9-month, and maybe we get a little bit more of it, cool off, where from the peak, the Boise, Idahos, the Austin, Texases, the place that exploded might be down 20%. Some other places might be 15, 12, or 10. So we've seen a little bit of that, whatever you want to call it, inflation of home prices fizzle out and come back down to earth. And over the next 3, 6, 9 months, if we get mortgage rates sub 5, not just for, the sake of the real estate market and for transactions, but just for everyone involved, it's going to create a more normalized market. So that's something that, I think a lot of us want to see, myself included. The vast majority of buyers I work with are first-time home buyers. So I want them to get into a payment that makes more sense for them. A lot of the buyers that I've worked with in the last 6 or 9 months might have had to stretch a little bit, but they got a good deal. They got seller credits. They're able to, have the seller pay their closing costs, so they're able to do a 2-1 buy down. These buyers, if they're able to refinance into a 5% The fact that they stretched to a $3,400 a month payment and might be able to refinance into a $2,900 payment is a win as well. So a lot of wins if we can, have some patience, let some economic data come out, let the lagging stuff like, the housing cost that's baked into inflation that we know is on the decline, but truly in the inflation numbers show that it's increasing. Housing and rent are both coming down, but the inflation data lags, so it shows that it's increasing. When that stuff catches up, when inflation data starts to show what's really happening, which is inflation is coming down, that's going to have an effect on mortgage interest rates. They're correlated. You don't have to take my word for it. The data shows it. The proof is in the pudding. So hopefully this helps. We'll see. I've been wrong before. So, if rates shoot up to 8.5%, throw tomatoes at me. Tell me I'm an idiot in the comments. Do all those things. Like, comment, subscribe, share this video if I added any value to you at all. Check out the other videos on the channel. I got 800 or so here, and here. Thanks for watching. I appreciate you.